Hey there, TaxBots. I'm Justin Spicer from the Ohio State Legal Services Association, and I'm here with Kathy Hoover, staff attorney with the Low Income Taxpayer Clinic at the Legal Aid Society of Columbus, and Luke Minet, senior attorney with the Low Income Taxpayer Clinic of Southeastern Ohio Legal Services. Today, we're continuing our self-employment series talking about rental income and expenses. Feel free to leave a comment or question, and we will answer whatever we can. So I know we're talking about rental property in today's session, Kathy, but are we referring to a taxpayer renting their personal property, like a car, or renting their real property, like a house?
So in today's session, we're focusing on real property rental income, meaning people that rent out their real estate. We're going to talk about what rental income needs to be reported on your tax return, what type of expenses you can deduct, and how the rental activity is reported on your return. There's a lot of information to cover about this subject, and we won't be able to cover everything in today's session. This is just to give you a general idea of what to expect regarding your taxes if you decide to rent out some property, and to give you an idea of what landlords have to keep track of to meet their tax filing obligations. This is not meant to be legal advice, but just some general information. We recommend you consult a tax professional, or you can look at IRS publication 527 for more details. You can find that IRS on the IRS website at irs.gov/pub 527.
So Luke, let's start with rental income. How does the taxpayer calculate their rental income?
So generally, the taxpayer must include all amounts they receive as rent in their gross income. Rental income is any payment the taxpayer receives for the use or occupation of property. It isn't limited to amounts you receive as normal rental payments. There are a few types of common rental incomes. First is advanced or prepaid rent. So this means any amount you receive before the period it covers. So for example, when a taxpayer leases their property to a tenant, they will often collect both the first and last month's rent. This is considered advance rent and needs to be included in your rental income for that year. The second kind of income that needs to be reported is any money you collect when a tenant cancels their lease. So if your tenant pays you to cancel the lease, the amount you receive is included in rent. Third, any expense paid by the tenant. So if your tenant pays any of your expenses, like utilities, those payments are rental income. Because you must include this amount in income, you can also deduct the expense. As an example, let's say your tenant pays the water and sewage bill for your rental property and subtracts the amount from the normal rental payment. Under the terms of the lease, your tenant does not have to pay those bills directly, so you'll include the utility bill paid by the tenant and any amount received as rent payment in your rental income. The good news is you can deduct the utility payment made by your tenant as a rental expense, which we'll talk about in a moment. This may sound like a silly way to do things, but this is what the IRS requires.
So Kathy, if a person receives a security deposit for their rental property, do they have to report that money as income? Kathy, I think you might be muted.
Sorry about that. No, you do not need to include that security deposit in your income when you receive it if you plan to return it to your tenant at the end of the lease. But if you keep part or all of the security deposit during any year because your tenant doesn't live up to the terms of the lease, you need to include that amount you keep in your income in that year. For example, let's say that your tenant pays you $1,000 security deposit to rent your house. If your tenant lives up to the lease agreement, like paying their rent and not damaging the property, you'll refund the security deposit at the end of the lease. If you refund that security deposit, it does not count as rental income. But if your tenant breaks the terms of the lease and you need to keep the security deposit, you would add that amount to your rental income.
So let's switch our focus to talk about rental expenses. Luke, before we get started talking about specific expenses, can you give our viewers a general overview of rental expenses?
Of course. So in most cases, the expenses of renting your property, like maintenance, insurance, taxes, and interest, can be deducted from your rental income in the year you pay for them. This can get a little tricky if you also live in the rental property for part of the time. If you sometimes use your rental property for personal purposes, you need to divide your expenses between rental and personal use. Also, your rental expense deductions may be limited. There are many rules about renting out a place that you can also use, so be sure to talk about your individual situation with a tax professional or check out IRS publication 527, which we mentioned a little bit earlier.
So Kathy, are there expenses a taxpayer can deduct?
Yes, so the taxpayer can deduct, for example, their cost of advertising the unit or property, cleaning and maintenance, insurance, legal and other professional expenses, repairs, utilities, or property management fees if you pay someone else to manage the property. You can also deduct mortgage interest paid to banks if you're financing the rental property, but only the interest, not the whole mortgage payment. You can also deduct the cost of taxes like real estate taxes, but you cannot deduct your personal income tax. There are very detailed rules about what you can deduct, so you'll want to either consult a tax professional or review publication 527 that was mentioned earlier.
Luke, how does a taxpayer report their rental income and expenses?
So if you rent a building, a room, or apartment, and you provide basic service like heat, electricity, or trash collection, you normally report your rental income and expenses on a Schedule E, and you'll do it on Part 1. Schedule E is just another one of the many schedules that may need to be attached to your tax return each year. You'll list your total income, expenses, and depreciation for each rental property. Be sure to enter the number of fair rental and personal use days on line 2. You can report up to 3 rental properties on a Schedule E. So if you have more than 3 rental properties, you'll want to complete and attach as many Schedule E's as are needed to separately list all of the properties.
So Kathy, does the taxpayer need to complete a Schedule C?
So in most cases, the taxpayer will not need to complete a Schedule C for rental income expenses. However, if the taxpayer provides substantial services to the tenant, they may need to file a Schedule C. The phrase provides substantial services is a term that means the taxpayer provides a substantial service that is mostly for the tenant's convenience. For example, if you provide regular cleaning, such as a maid service to the taxpayer, and the tenant pays you for that cost, you'd report that on a Schedule C, not a Schedule E.
So Luke, what happens if the taxpayer decides to use the rental property for personal use?
So if the taxpayer changes their rental home to personal use, other than in the beginning of the tax year, they must divide the yearly expenses like taxes and insurance between rental use and personal use. You can only deduct your rental expenses. You cannot deduct depreciation or insurance for the part of the year the property is being used for personal use. But you can include the home mortgage interest and real estate tax expense for the part of the year the property is held for personal use when figuring out the amount if you elect to use itemized deductions that are deducted on a Schedule A instead of the standard deduction. So for example, let's say you moved from your home in May and started renting it out on June 1st. Since you're collecting rental income for 7 months in this calendar year, you can deduct as rental expenses 7/12 of your yearly expenses like taxes and insurance. Starting with June, you can deduct as rental expenses the amount you pay for items generally billed monthly, such as insurance or utilities.
Great. All right. Thanks, Kathy. Thank you, Luke, for this important information, and thanks to everyone for tuning in. As a reminder, this segment and all the others in our Tax Chat series are available on our Facebook page. Thanks, and we'll see you next time.